This is Ryan Munn and Scott Graves. We are live on Satoshi Ratio Pt2, part of the Innovato2 podcast, and M the Media Project and Interchain.Live collaboration. Scott, thanks for joining me again.
It is great to be here. You know, what can I say? I love doing the Innovato2 podcast with my co-hosts.
Yeah, it's been a lot of fun. So last time we got into some of the questions around blockchain and Bitcoin, just really kind of dove in. But to the point of the name here, Satoshi Ratio, one of the topics that we got talking about a little while back was really about finance in general, right? We talk about trade and traders in the markets, or talking about equity in companies or buildings. It's all tokenization, really. Even long before crypto came out, when you break down a company into a bunch of shares of stock, those are tokens that equal some percentage of value in that company. And so when we start talking about Bitcoin in particular, it's a token that's on this network, but Bitcoin is actually divisible 100 million times, right? One single Bitcoin has 8 decimal places after it. So a 0.00000001 Bitcoin is 1 Satoshi.
So let me ask you something before you go any further.
Yes.
When I'm hearing investors in Bitcoin speaking of quote end quote mining Bitcoin, is it that sort of derivative nature of Bitcoin that they're referring to, or are they referring to something different? I sense they're referring to that. Yeah. But how is that any different than a derivative of any other type of financial investment? You know, where you can take a stock and you can, you can divide it, and each individual share becomes less valuable then. But overall, there are strategic reasons why a company would do that to their advantage.
Yeah. So for one thing, a Bitcoin is already predefined to be divisible this 100 million times. I mean, really, the decimal is an illusion. You could just get rid of it, right? Yeah. But the fact is that divisibility is baked into the day one programming. Unlike a company where they could sell stock and then make a decision to split that stock, which is different than, say, Robinhood and the like, that allow you to buy fractional shares, right? Those things in the terms of Bitcoin and in many cryptocurrencies are predefined. So that Bitcoin, where you place that decimal, was kind of arbitrary, but they decided in the code that they would place it after 8 zeros. And so that's how divisible a single Bitcoin is. And so from day one, if somebody was quote unquote mining, securing the network and getting those token rewards for that security, they were getting a certain amount of Bitcoin, at the time 50.
Is that perceived by Bitcoin investors as being more fair or more transparent, or how would you characterize that?
Yeah, I think that is the attraction right from day one. There's 2 pieces of this. One is that sort of rule set is set in stone, right? Yeah. In theory, it could be changed, but it'd be really difficult because everybody involved in the network would need to decide to agree to change it. And why would they if it devalues what they have, right? So for that reason, that's really set in stone, and that's part of the value or attraction of that intrinsic value of Bitcoin. The other piece is the monetary policy or the distribution policy of how those go out. So they go out over time, and over time, that reward reduces. In theory, making sense, the value goes up, therefore the actual monetary value of the reward is going up, but the actual number of tokens needed to hit that reward go down. So day one, when Bitcoin was launched, we knew roughly that you could earn 50 Bitcoin every 10 minutes back when they were worth 0. And after about 4 years, that dropped in half and went to 25. 4 more years and it went to 12.5. 4 more years and it went to 6.25. And 4 more years and you're at 3 and whatever that works out to, 3 and 1/8. Right. Okay. So that's where we're at now, is that we've got these much smaller rewards. But again, back in the day, it was worth nothing. Now it's worth 100,000 each. So that really starts to balance out. And you have a larger and larger network that requires more value to be worth running. So these things are all sort of naturally playing out. And so that distribution policy has a limit, right? Because it's going down. in theory, it'll always keep, you can always keep having a smaller and smaller fraction, but really somewhere out in, year 2100 something, it'll hit a maximum of 21 million units in circulation. But right now there's somewhere around 18 or 19 million units in circulation. So we've reached pretty much that point where we're pretty close to that supply. And so that is a deflationary currency, right? Whereas the money supply that we have in fiat, in government controlled currencies, we're always making more. We put it out there so that banks can lend it, because really there is a value to that, right? Because it'd be great if you could hold your dollar and it was worth more the next day, right? But that would also make it really hard for economics, for value creation to get distributed to more people and be
or
able
for the transaction of value,
right?
For value to pass from one person to the next.
Yeah, if you suddenly was hard to get a hold of dollars in order to do business with them, well, that would make them artificially too valuable, but also just drive business to some other currency, right?
Yes, yeah. Well, and we've the specific to our country, the United States has experienced that in years past, namely, and for its first time, post-American Revolution and before the Constitution, right? There's not a lot of currency rotating around the United States. There's a lot of different currencies rotating around the United States. Almost none of them are very valuable at all because of inflation during the Revolution, and so people are desperate for hard currency, and it had all kinds of social consequences.
Absolutely. And there was a point in time when our currency was actually tied to gold and tied to silver, and there was a valuation correlated to hard assets. That correlation was broken many years ago with Bretton Woods Summit, and that correlation has created this demand for hard assets. So, it's why people invest in gold and silver. It's why people might buy treasury bonds, because they see those things as more secure over time and as a hedge against inflation, which is this ability to print money at will. So Bitcoin and many cryptocurrencies have this rule set really baked in day one. And so that's where Bitcoin got its original metaphor of digital gold. Similar, the metaphor of mining, right? That concept is, it's the idea of picks and shovels, but really using a computer to do math. And the math isn't really creating the Bitcoin as much as securing the network, which is rewarded with Bitcoin. So it's not the same as digging stuff out of the ground, but it's conceptually...
It is a 21st century digital version of mining, though.
Yeah.
It's a new conception around that idea.
Yeah, you're, instead of contributing to the work of digging things out of the ground, you're contributing to the work of securing infrastructure. And not just infrastructure for this money system. I mean, if you really think about it, the loads utilized by, say, a big data center mining Bitcoin is not only a customer on the grid, but it's also an incentive for a more resilient grid. And it's also potentially incentive for grid infrastructure in rural, remote places, right? Where maybe you can get some power cheap, or you can put some solar out, and there's other ways to power these things, so that ultimately there's the capability of building out infrastructure and incentives really anywhere, regardless of who the regime is necessarily. If there's one regime that's not friendly, then that just makes it more appealing to go to another jurisdiction to do these, to build these things. And so the influence on the global markets has been interesting, because Bitcoin can be traded in any jurisdiction at different rates. So any particular exchange, depending on what partners they have for back-end liquidity, you'll often see variations in the price of Bitcoin around the world, and even across different exchanges in the same country, just based on the depth and liquidity of that particular marketplace. How many people are stating a price they're willing to sell at, and how much are they willing to sell, and how many are stating a price they're willing to buy at, and how much are they willing to buy. That's what creates the order book. That's what creates a price. And that's not unique to Bitcoin, right? That's every commodity in the world, every stock in the world, every market in the world. The only difference is all of those markets have one price because they're regulated by a central authority. And these markets have variable prices because they're regulated by free markets.
Well, it's interesting, because what makes it, my words, not anyone else's, what makes it a quote unquote real market is that it is using the same mechanisms, right, as those other markets. But it's not affected by the world's perception of any one nation's currency, which is kind of interesting. You know what I'm saying? It's that's what I'm at least hearing from
Yes,
what you're
yes
saying.
and no. Yes and no.
So describe for us then why that's a yes and no. Because what I'm hearing in what you're saying is that the like the mining of Bitcoin, right? The extraction of Bitcoin has at the same time at once it has many of the same sort of characteristics of any other trading market, with the fact that it's in this strictly digital realm, right? So why would it really ultimately matter if I'm in Pakistan or the United States or Canada or wherever I am? Why would that really ultimately matter, that I might be starting off with value to buy into the system with a dollar versus a dinar or a Canadian loon, or why would that matter?
Yeah, so if you're in a small country that has, whatever whatever currency they have, and say you don't have access to this, then the only way to get dollars is either through the banks or on the street. And I actually experienced this living in Chile for half a year, and I traveled to Argentina. And that's where I learned that there were two kinds of US dollars in Argentina. There's the US dollars that you could go to the bank and exchange your pesos for, or exchange your dollars and get pesos. And that was one exchange rate. But there was a different exchange rate for what people called blue dollars, which are basically like black market dollars. There was a different rate on the street if you knew where to go to get.
So is there a premium? Was there a premium for blue dollars because it was a little riskier, or what?
No, there'd be a discount for blue dollars. So in other words, going to the bank, you'd pay one rate for US dollars.
Right.
But if you had connections to get access to hard cash US dollars on the street somewhere, you could pay a little bit less to get them that way. Right? There might be risk there. You're getting a discount because of the risk of dealing with whoever you're dealing with to get those dollars, because where did they come from?
Okay.
Right? But that's the nature of this, is this being on a ledger. Similarly, Argentina is a country where Bitcoin's been pretty popular because they have currency problems, right? Which is why this blue dollar thing exists, because they've had inflationary problems with their currency. And so why would you go to the bank to trade your currency if it's going to inflate really fast by the bank's rates, if you can go to somebody else that has a lot of dollars that maybe doesn't need to keep them all the time, right? Needs to make them spendable locally, and they trade them for pesos. So when you introduce Bitcoin into a system like this, you now have a relationship between Bitcoin and the US dollar, Bitcoin and the local currency and the US dollar. And you create this triangle of trade that can occur, and it can be unique to that particular market because there's only so much liquidity and depth in the US dollar market, in the local currency market, and in the particular Bitcoin market that folks might have access to. Bitcoin being global, the challenge is, how do you get your real dollars into a system that you can trade for Bitcoin? Mm-hmm. So there's sites where you can, make connections with people, and so you can go meet somebody in person and trade your dollars of whatever type and Bitcoin directly. And so, if you understand Bitcoin and have confidence in it and understand sort of the volatility and are comfortable with that, Bitcoin can be a great hedge against inflation. But if you're just in a country that has bad inflation, US dollar is a great hedge against inflation.
Yeah, that's right. Yeah.
Right. And so depending on what inflation is doing at any given time in that country's currency or the US dollar currency, that can affect the supply and demand in both the traditional bank market and the street market of those currencies. And so you can extrapolate this to all countries everywhere that are all trying to control their own currencies, some of them tied to US dollars, some of them not tied to US dollars, like Chinese yuan, right? They're doing a lot of work to have trade outside of the US dollars with BRICS. And that's just barter is what they're trying to build. They're not trying to create a new currency. They're just trying to create the rails for barter, which is what blockchain is, the rails for barter. It just happens to have tokens associated many times to incentivize the maintenance and security of those rails.
Yep.
And so when I start talking about Satoshi Ratio, it's this concept that as a trader in the crypto space, you're acutely aware of the variable price. You could trade one single currency, and you could even be trading US dollars versus US dollars tether, which is a crypto US dollar. And that could have different values in different marketplaces based on the movement of that market and the supply and demand for tether in that market or US dollars. Because tethers on blockchain, you can more easily move it from one exchange to another. But the dollars, the actual US dollars held within an exchange, can't be moved from one exchange to another. So that sort of fluidity of the crypto version of US dollars is USDT, USDC. There's a number of these, they call them US dollar stable coins. So they're just crypto versions of a US dollar that are highly mobile around the world across exchanges. Whereas my true US dollars, my actual US dollars, require a bank wire to go somewhere else, and that takes time and has an extra cost in itself. So if I'm a crypto trader and I see that Bitcoin is trading at $150 discount on another exchange, I may say, let's just swap my US dollars for US dollars tether, even if I'm going to pay $1.01, because this is being seen by other traders. There's a supply and demand where it's actually going to cost me a tiny bit more to get a hold of that US dollar tether. But once I have it, I shoot it over to that exchange, wait for that process. Hopefully that timing works out, buy that Bitcoin at the lower rate, send that Bitcoin back to the exchange with the higher rate, sell that, and now I've made a profit on arbitrage.
You've made a profit on arbitrage, and you've, I guess, sort of is the right characterization. So you've been a help to foreign nationals, you know, for whom it is still a more fluid and more affordable dollar, who are also just highly interested in trading in dollars because of the perception of the US dollar.
You also got to ask yourself, why is there that difference in the Bitcoin price? Is it somebody in one market is flush and selling, or I don't know, they're in the middle of a divorce and they've got to liquidate, right? And that's driving the market price down in that market. Or is there a new news piece that came from BlackRock, and even though they're selling their ETF, you've got people on the trading markets going, oh, that's increasing demand, and they're buying up the Bitcoin, driving the price up.
Well, and now we're getting into real trading strategy. But before we do, I just want to close the loop on the Satoshi ratio as a phenomenon being defined by you. So the ratio is what? The differential between.
So the ratio, so we're one step away from that still, right? So all of this variability is the nature of that market, right? It's what real markets would do if we didn't have centralized control over NASDAQ, and whichever market a stock is on, that's the market that sets the price.
Yep.
In this world, that's not true. And so these prices vary all over the place. And so if you're in the traditional market and you're trading, cash is king. You're always thinking of value relative to cash. And that should still be true if you're crypto trading. But the key difference, and this is where the Satoshi ratio comes in, is understanding that triangle, that trifecta, right? Because you can go out and trade Bitcoin, and you can go out and trade any other currency for US dollars. US dollar is the most available currency. That's where you'll find the most liquidity. And you could play with arbitrage between other currency markets if you wanted to. But what you can also find is that almost every crypto out there is traded against Bitcoin also. So in other words, you can look at two prices side by side for anything besides Bitcoin, and you could say, okay, here's the price of Bitcoin, here's the price of dollars. Now here's the price of Ether in dollars, and here's the price of Ether in Bitcoin. And you could be calculating arbitrage between those two markets, between a dollar-denominated currency and a Bitcoin-denominated currency. And since we're talking about the crypto market, and Bitcoin is sort of the derivative that the entire market comes from, that is a very key factor in how to think about the valuation of a cryptocurrency, or frankly, I would argue any asset in the world could be valued against Bitcoin and valued against US dollars to get a better understanding of what it's really worth.
Right.
And instead of having one price that you have to absorb as a population, which really leaves out a lot of really important information, you actually have two prices. And this is where I would say, here's your US dollar price, and here's your Satoshi ratio, right? It's how many, what's that ratio between dollars in Bitcoin and, say, Tesla stock in Bitcoin?
Yeah.
Right. And that informs you on the direction the market is going, based on which direction that arbitrage appears to be available.
You take those two, you take those two numbers, and their relationship is going to go either from left to right up, or it's going to go left to right down. That's the ratio.
That's the ratio.
And that then is a measure to determine for you. That's giving you some sort of differential and a direction. It's giving you a sense of direction in which you can you're either going to sense a loss, or you're going to sense some sort of potential profit.
That's right. That's right. Now, you may not actually be ready to take that trade. And frankly, trying to make trades on arbitrage as a person, it's almost not doable anymore. Like 10 years ago, you could play that game in crypto. Nowadays, it's more about big swings, or it's auto trading, right? Like you have.
Well, I was going to say, this is because we live in the age of computers, and fast trading, where like you can't possibly.
And because the margins are getting smaller, right? 10 years ago, the margin in these arbitrage trades, like you could look at one and go, oh, I'm going to make a 20% return, and the market's just a little bit as you're going, and you only get 15% return. Well, that's okay, right?
So the relationship,
3.5% return, and it goes the other direction by the time you get your money moved from one place to another, that's a loss. And so trying to play arbitrage at the speed of humans now just doesn't make sense, because the margins are getting smaller because there's lots of professionals in the game.
Okay, and in other words, the ratios themselves are in small fractions.
They're getting smaller. Yeah, absolutely. Yeah. And so to sort of illustrate this too, I'm going to pull up the chart that I use.
Cool.
And what I do is I sort of, let me see if we've got it set right. Yeah. So I don't know if that'll show up. Yeah. So this is a little app called Tab Trader, and it's a little hard to see there, but basically I'm looking at the price of some of the top cryptos side by side in a Bitcoin price and in a US dollar price. Sometimes mostly US dollar stablecoin prices. And so looking at that, I can see basically maybe the price looks like it's going up in US dollars, and that might look like a good trend and people would look to buy in.
But it's not that, it's the relationship between that up against whatever cryptocurrency you're using on the other side of the ratio.
Yeah, there are some people out there that are real like Ether maxis that try to do this with Ether, and there's an argument to be made for that, because a lot of the tokens out there are on the Ethereum blockchain, and so there's a validity to their relationship to the value of Ethereum. But when you look at the overall market, you look at the actual capital trade going on day to day in a 24-hour period, the depth and liquidity of the markets, they're all still very heavily tied to US dollar and Bitcoin. And those ratios continuously influence the actual value of all these tokens on a day-to-day basis. And so it also makes it really obvious when something is bucking the trend. When something, it's going up, but also you can see it's going up when Bitcoin's going down, or vice versa. Those are the things that can really indicate where there's value, or where it's just hype, where something's getting pumped because of hype. So you can see that, Bitcoin's going up and then something else is going up more. A lot of times that, in my opinion, is the hype cycle pushing it. But when something goes down, and then when Bitcoin goes down and then something else goes up, that's more of a correlation of real value. That's basically saying, okay, the market's tired of Bitcoin now, I'm going to go into something else valuable, and that next valuable thing goes up. And if you time that right, especially if you're trading directly with some of these cryptos, that can be a more profitable net way to trade, because the other thing that happens is once the market really tires out, and even though everything tends to go down, all of those alternatives tend to go down even more than Bitcoin does. And so as volatile as Bitcoin is, as people perceive that as the high risk thing in the traditional markets, it's the least volatile. It's the least volatile cryptocurrency in the entire crypto market. And it has the most liquidity and the most depth, the most collateral value. You can actually lock up your Bitcoin and borrow dollars against it and go out and buy a house. So there's a real world application there that's functional, where a lot of cryptos don't quite have that yet, or even if they do, it is a much more limited extent compared with Bitcoin.
So as far as our conversations in and attempting to get more widespread acceptance of cryptocurrency use, right?
Mm-hmm.
Something just occurred to me after our last couple of conversations, which is, you've got folks that for whom traditional, stock trading just seems so overwhelming or so intimidating.
Right.
To the point where, I'm not interested in learning how to break it down and really get a better understanding for it, even though I know at least part of my life somewhere along the line, gets affected by this, good or bad, and I should know more about it. And then you add, this, for so many people, what seems to be like, oh my God, this is this whole other world. When the reality is, don't get hung up on the format. Although there are key elements to blockchain, right?
Yep.
That this is the whole reason why you and I are advocating for it, right? It actually is a more secure trading platform, right?
Well,
it's a more
blockchain's a ledger, and so it's a more secure accounting platform.
Yeah, there you go.
Yes. In fact, it's a triple entry public ledger. That's exactly what it is. It's a triple entry public ledger.
So are you fearful that just sheer intimidation is going to just continue to stand in the way? I sense there are a lot of people against this, not because of the hype that they read or that they hear, right, from various media outlets, but because it just feels intimidating, like so many other financial parts of our lives seem intimidating to people.
Yeah, absolutely. And this is one of those things where, I struggle a little bit, because I don't necessarily want to be a Bitcoin maxi, but at the same time, I believe that, from its inception, it's been doing a certain thing in our economy, right? And that thing is penetrating the bubble of obscurity. And the people using it, though, don't necessarily need to do that or know that. They may do that, and they may learn about it, and they may discover things because they learn about it, but they don't necessarily need to. And that's the piece that's always kind of stuck out at me, is that, we have this system today where if you want to actually work hard and retire, you kind of have to understand finance. So we have a society that says, go become an expert in what you can do and go do your best at that. And oh, by the way, if you want to retire successfully, you're also going to need to become basically an expert in finance.
Right.
Because if not,
when we broke the employer-based pension system, for this brave new world, 1978 401k, added to the tax code. Okay, great, except just what you just described. Like all of a sudden, and it's not exactly like we started a nationwide program,
right,
for making everybody a financial expert.
No, not at all.
The insurance companies and the financial sector said, we have this disclosure, and as long as we read this to people, there's always risk, and you're on your own. Right. So right. I mean, but the fact still remains, right? A lot of the tension in our society today is that we're being dragged kicking and screaming into redesigning society, right? And have been virtually our entire lives. You and I, we're in our 40s. This has been going on for a little longer than our entire lives, right?
Yeah. Oh yeah.
And so but tonight, we're focused on that financial portion of our lives. That I sense like, so maybe then one of the solutions to making this a more accepted practice in getting ours and many other governments to make this a better place for everybody to live and work, so to speak, in this realm by accepting, right, the currency as exactly that, as a form of currency that is accepted, that is widespread, and that therefore is, and this gets us the closest we've ever been, by the way, in the history of whenever, at least the, modern finance, to a self-regulated market that's actually incentivizing people to do the right thing, right?
Yeah, well, to your point, a self-regulated market, I mean, all these folks that are in 401ks, if they just had the wherewithal to go in and find the option that was directly tied to the S&P 500, they would have been better off in most cases than whatever other portfolios they were offered.
Yeah, they just were not given that access.
Yeah, or they didn't know that was the way to go, right?
Yeah,
they were told, oh, if you want to be safe, go here. If you really ready to take some risks, go here. And the reality is that the S&P 500 option was kind of right in the middle somewhere, and it's performed better in most cases.
The better average over the last 50 years, period. But again, not informing people is a form of not giving them access.
Right.
Because it's the information that predicts success or failure, right? So if we all agree this is the information, this gets back to where we've been so many times on so many other disciplines that we've described on the podcast, is, if we're in the information age, then the information is the currency, the information is the value, right? Yeah. But if we don't give everybody access to be able to use it correctly, that's kind of like saying we're going to pick winners and losers.
Right. Yep. Absolutely. Yeah. So this breaks that down in many ways because it is open source. Kids can learn about it. People can learn about it. You can buy $5, $10, $100, $1 million worth, and whatever it is, nobody can really stop you. Right. It's ubiquitous across the world at this point. And the learning that enables can't be stopped either. Yeah. Other than sort of drowning it out with a bunch of noise, which is what often does happen. And so, my fear around Bitcoin and cryptocurrency is that people perceive Bitcoin as very risky. So then they get over that perception and engage in that risk. And then they feel superhuman and they go ahead and go, oh, well, how could this other thing be any more risky? Right.
Well, yeah. So at the same time, we got to temper that with, this is a trading market. There is a risk. What we're saying is it's a more transparent, and the incentives are designed in a way that it reduces criminality, right? Yep. But that doesn't reduce per se financial risk, because you're trading, you're taking risks. It's just it's a more legal place to take risks.
Part of the risk is always tied to time, right? It's all about your time horizon. If you have a short time horizon, then it's a much higher risk perspective. If you have a longer time horizon, then again, in my opinion, and this is not financial advice, I probably should have said that at the beginning of this, but
we'll say it.
It's not as risky, substantially less risky than a lot of the other things out there, for the simple fact that there is that liquidity in that market. There's a sheer volume of people engaged in that value creation, whereas other things that are like, oh, we're doing this better and this better and this better than Bitcoin. What they haven't done better is actually get the network adoption, actually get the decentralization, actually get the security that makes it live and survive and be censorship resistant and able to, survive all the challenges that this hardened system has survived. And so that's where, I want people to begin to explore the idea that, hey, maybe you're not comfortable with this, but what we want to recognize is that this is piercing that veil of obscurity in an already broken monetary system, because there's already things going on in that system that we can't hold accountable and transparent. And so if we can ask governments, if we can ask banks to take this on for us, ideally that can make them more secure, more reliable, more transparent institutions to be serving us. And you can see it in El Salvador. You can see it in other countries. It incentivizes clean energy. It incentivizes responsible fiscal policy, right? That Bitcoin in that wallet it's in that wallet. If the president of El Salvador decides to move it to a different wallet, everybody can see that happen on chain, and they can think about what they're going to do with it. Everybody's watching the Bitcoin held by the U.S. government right now, right? There's like $6.5 billion of Bitcoin held by the U.S. government that we don't know. Are they going to sell it? Are they going to sell it at once? Are they going to sell it in tranches? Are they going to decide to keep it? Are they going to put it in reserve? How are they going to handle that? And based on how they decide to handle that, it's going to move around on chain. And so even if they don't tell us how they're going to handle it, but they move it into some place where we know it is more liquid, right? That's going to be potential risk that it's going to get sold and depress the market. If we know it gets moved into some wallet that's held by a vault operator in Switzerland, well, then it's probably not going to get liquidated anytime soon, and it's being secured in some way. That
what's interesting about that is that this gets back to this is a more transparent, there's more freedom of transparency in this market, because like you say 6 billion shares, and I think to myself,
$6 billion,
the government, $6 billion rather. And you go, oh, the government wants to manipulate this market at some point in time. But this just makes it virtually impossible to do that. I mean, they can still take the move, but we're going to see it.
Yeah.
Or be able to somewhat anticipate it if you're hitting, if you're watching at the right time, which you don't necessarily get to do in the traditional publicly traded markets. And governments do this all the time to each other.
Right, like oil. Look at actually Biden made some pretty good trades with oil during his presidency, and we know about that because it's required that those things get disclosed, and there's rules and policies around it, how it gets disclosed. But if those were all on blockchain, there wouldn't be any necessary disclosure if the program and the blockchain and the parameters were all defined to say, hey, when this thing happens, these notifications occur.
Yeah,
and
right. So it happens in real time.
Yeah, exactly. We can set those rules, and so that's the slate that we have to draw on, is all this ability to define the way ledgers work, the way the accounting works, set the rules on the transparency and the privacy and the accountability on it. And Bitcoin's just the tip of that needle to help people learn about it, but it's also the piece that penetrates that veil around the world. So it's potentially valuable for any currency or for any government to use that. And there is a definite strategic question to say, hey, if the US government is potentially in control of $6.5 billion of Bitcoin, what is a responsible way to handle that, right? Is it responsible if they sell it? Is that actually considered responsible? Or is it responsible if they hold it? Funny enough, actually, too, a good portion of that Bitcoin, I believe, is derived from the Bitcoin that was stolen from Silk Road by a couple of feds that thought they would get away with it.
Oh God! So whole other podcast for a whole other time. That's
exactly. Yes. So there's a lot of story that keeps coming out of this, and there's a lot of history that people can learn from, and it's really enlightening for those that want to. But the other thing about this is that not everybody has to, right? If we have systems like this in our society, not everybody has to figure it out. That's the whole point of society, is we have systems and social contracts that help take care of people and meet people where they are. Not everybody needs to have a crypto wallet. Sure, we could say you might be better off in society. You might have a better chance to pull yourself up in society if you engage with this. Yeah. But that's not to say that people aren't still going to support their families and their spouses and their kids, and they're going to go off and do other things, right? It's some people are going to go be an artist, and that's what they're going to do, and maybe they learn how to make NFTs with their art, or maybe they just have a buddy that helps them do the business side of what they do, right?
Yeah, it's different for everybody, but to give people that option,
Absolutely.
So one last question, which is sort of like a precedent to a future episode, and then we just want to mention a few places to subscribe and so forth. And that question is, it seems to me, after everything we talked about in these last two episodes about how this marketplace works, where does this, or does it, intersect in a conversation about changing the whole central value that we place on everything else around us? In other words, I've over the years have had some pretty wild conversations with just interesting people I've met over the decades from different parts of the world, with the notion that, like, hey, if we set, rather than having the world value propositions set on petroleates as an example, what if we did it based on on kilowatt hours, or on the kilowatt, or on it seems to me we could actually do that in this blockchain world.
Yeah, this essentially starts doing that, right? There have even been some experiments where, you can get sort of a specific signature off of a solar panel and batteries. So there's ways to sort of cryptographically track energy in and out of batteries or coming off of specific sources of energy production. And so that's where it gets really interesting, is this idea of a tokenized world, right? We already have it. In reality, we already have kilowatt hours, right? That's how we tokenize electricity. We've been getting bills billed in tokens. They're just kilowatt hours that we pay X number of cents for. And so everything in our world is already tokenized. It's just not tokenized in a cryptographic public ledger. And so this idea of turning tokens into something digital as an actual digital cryptographic pair and onto these ledgers opens up this idea where, again, if you go back to where Bitcoin started, it was during the financial crisis. It was during Occupy Wall Street. Yeah. And so what we're really talking about is creating systems of institutions and tokenized commodities, assets, equities, everything in a way that nothing is too big to fail. Right? We experienced too big to fail. We watched banks get bailed out. We've watched the auto industry get bailed out. But the reality is that the reason why that happens is because there isn't enough flexibility and true market dynamic in those systems, and they're propping up extremely powerful centralized institutions.
It's one of the most concrete facets of proof that we get that our quote unquote free market is anything but a free market. Yes. Markets are made by man, and man has manipulated markets from the beginning, because there's only one way to have markets, and that is to manipulate them. In a sense, but not that manipulation is always a good thing. Sometimes it is a good thing, but sometimes it's not a good thing.
Yes, markets have a tendency to create a winner-take-all scenario, and especially when everything gets denominated in one thing. And so this is where I go against the Bitcoin maxis, where they believe the Satoshi ratio is kind of the be-all, end-all, and they look at the Bitcoin and dollar and everything else. Well, the reality is that we're all producing data every day that's getting transacted, and there's a lot of exchanges of value that can and should occur without any dollar valuation between them. Okay. And the more interchange of value that we have across chains, so interchain values, yes. This is where we start to create balance and resilience, right? Where nothing is too big to fail. Nothing is a little puddle with a boulder dropping into it, losing all the water. Everything is a big old pond, and if something goes wrong, it's a pebble in the pond. And
so I won't characterize that as decentralize your currencies. It's decentralizing your value centers.
Absolutely.
Decentralizing them and integrating them at the same time. And that creates a resilient sort of textile fabric,
Absolutely. Absolutely. And, to the old farmer, concept, you may have a flush of hay this year, and, another farmer might have some more milk, and you're going to make a trade. The difference here is that when it's all on ledgers, that trade can influence the value of everything else in the markets, even though it wasn't denominated in a particular currency, because those markets are all interconnected. And so this is where I believe the Satoshi ratio is just the tip of the iceberg, just like Bitcoin was the tip of the iceberg, in people understanding that concept of barter and economics and trade of value. And that's where I think we can leave the Satoshi ratio and let everybody know that if they want to learn more and keep learning, join, like, and subscribe the Interchain.Live channel. Look for our Innovato2 podcasts on the SM Graves and the Media Project, and just keep watching. Take a look at Boston Blockchain Association, the work they're doing, the Government Blockchain Association, the work they're doing, and demand that your public leaders, your public servants, go get the free access and education to this information, because if they're not doing that, they're not doing their job, no matter what party they're in.
Right on. Help us spread the word, folks. Help us change the world. That's basically our message, right?
Absolutely.
And you can find the Innovato2 podcast both on Apple Podcasts and on Spotify and many other platforms that whatever happens to be your favorite podcast dissemination platform. I don't even know if that's a thing, but it sounds cool. Just look up Innovato2. And also, hey, for that matter, subscribe to us on Instagram at Innovato2 the pod.
Awesome.
Yeah.
All right, guys. Take care.